last thing we want to evaluate when we're doing when we're looking at our historical performance of our firm is the credit health and financial structure of the firm. So we've looked at already return, ROIC, and the revenue growth. These are the two most important things driving value creation. But one of the main things that could hold us back, regardless of our return or revenue growth, is if we have a poor financial structure, if we have bad credit health. These are the kind of things that can hold the company back. So we want to look at both of them. And we're going to look at sort of two things, and this is pretty common in analysis. We're going to look at short-term and long-term financial health. And in finance speak, that means we're going to investigate the firm's liquidity, which is its ability to meet short-term obligations. We're going to look at a couple of liquidity ratios, but mainly what we call the interest coverage ratio. And then we're going to look at leverage, which is our ability to meet our long-term obligations. Leverage is typically measured by our debt-to-value ratio or our debt-to-equity ratios, but this is mostly just a measure of how much debt the firm has. And likewise, the interest coverage ratio is just a measure of how much interest we have to pay every month to cover our debt payments. So these are both a measure of debt. And what we're interested in is, first, how's the company financed? Is it mostly equity? Is it mostly debt? Where does the money that buys our invested capital come from? And second, based on that, is that capital structure sustainable? If we get all of our financing using debt and we enter into a recession or a downturn, or a virus sweeps the world, like what's going on right now, which companies are going to be able to survive? Well, a company that is financed mostly with debt, primarily with debt, has really high interest payments and doesn't have a foreseeable cash flow from the future because all of its potential customers are locked down, is going to have a really hard time surviving, right? So now is the perfect time to think about, investigate, look at the financial news. What kind of companies are around? What kind of companies can potentially survive in this kind of environment? And that's what we mean when we say, is this capital structure sustainable? So this is what we're looking for in the history of the firm. And we'll start by looking at the short-term ratios. The basic short-term liquidity health ratio is called the interest coverage ratio, and it's usually some form of EBITDA or EBITDAR over interest expense. So all this is saying, again, go back and look at your simple income statement. All this is saying is operating profit, which is EBITDA. The things that follow operating profit are interest expense. So what we want to look at is how much of our interest expense is covered by our operating profit. And here we want a really big number. Again, the best way to understand a ratio is to think about the situation in which the ratio equals 1. If the interest coverage ratio equals 1, it means our operating profit is exactly equal to interest. And that means we have enough to pay all our bills, to pay the interest on all our debt, but no more, not a dollar more. And that's a bad situation for a company to be in. It's a bad situation for anyone to be in. We want to have way more profit, income coming in every year than we have interest requirements, because things can happen. And downturns can happen, and anything can happen. And we may encounter a situation where we are a little short, or we have less revenue than we're used to, and we don't want that to impact making our interest payments, because if we miss an interest payment, we're automatically in default. That's a legal requirement. Firm goes into bankruptcy. Situations like what we're in right now are rife for huge numbers of bankruptcy. And like this could be just like following 2008, where we saw lots and lots of firms with too much debt and too high of interest payments not make their revenue expectations, not be able to cover their interest payments. So we're looking at here is a firm, UPS and FedEx. They both have vastly more EBITDA or EBITDA than interest payments, right? We're looking at ratios in the hundreds here, 7 billion in EBITDA, but 8 billion in EBITDA and 348 to 380 million for UPS in interest, right? So dozens. This ratio is 40 or something, which is great. That means we have way more ability to pay our bills than we actually need. Right? These two firms could take huge hits to revenue and still not be any financial trouble. That's liquidity. They have lots of it. So you can see that we can use lots of different measures here. We can use EBITDA, we can use EBITDA or EBITDAR, which is an unusual one, but for firms with lots of rental expense, this could be really, really useful. And so particularly here, if you look at FedEx, their rental expense is quite high, almost $2 billion in rental expense. And that's because they have these sale leaseback obligation with regards to their airplanes. They've sold their planes, they're leasing them back. It's called operating leases. We've talked about this a little bit so far. We'll talk more about it. But what we want to look at is rental expense is just like interest expense, in that we have this signed obligation and legal contract to continue paying these rental expenses on these planes, just like you do if you have an apartment. And so we want to be able to look at above and beyond whether they can pay their interest. We want to look if they can pay their rental contracts, because that would put them in default, just like failure to pay interest. And so we look at FedEx and we see that they're actually closer on the margin. If we divide EBITDAR, which is earnings before interest, taxes, depreciation, amortization, and rental expense, and if we divide that by rental expense and interest, we see that for FedEx, they're much closer to the margin than you might expect. Right? 9.362 billion divided by 2.511 billion in 2013. That's only about a little more than 3. And so that's a lot closer to the margin than if you just look at EBITDA over interest. Or even, for instance, EBITDAR over interest and rental expense for UPS, which is significantly less. That's still about 10, which is much better. Okay, so these are all ways that we address short-term health, short-term financial health. There's a lot more, but this is probably the main way. Now, although EBITDA or interest coverage or the time to interest earned ratio, all those are for the same thing, is one of the most widely used ratios to assess liquidity or short-term financial health. One of the most widely accepted measures of financial health in general is called the credit rating of the firm. And this is a rating that's assigned to companies that's very similar to, say, the credit score that's assigned to individuals. Instead of a numerical number like a credit score, the credit rating is a letter-based ranking, going from AAA, which is the highest, down to BB, down to C. Actually, the lowest rating is called junk, right? And this is a rating that assesses credit health. So at the very top of the rating, the AAA rated firms, these are the most financially secure companies. And typically the way we understand credit rating is likelihood of default within the following year, meaning we assess the potential for a firm not to make its interest payments in the following year. And a firm rated junk has a 50% chance of failing to make an interest payment, meaning they're pretty likely to default. Whereas a AAA rated firm has less than a 99% or greater than a 99% chance of not making. Has a 99% chance of making its interest payments. Sorry. So you can see that these rankings tie pretty closely to the interest coverage ratio. If we match up these two histograms here, you can see that the AAA rated firms have a really high interest coverage ratio, AA, and then as we move down the rankings to, in other words, as we move to worse financial firms with worse financial health, you see that their interest coverage ratio declines. And this has a pretty strong correlation also with the yield to maturity on the company's debts. So on the right-hand histogram above the rating, you can see the most common yield to maturity, average yield to maturity for firms in that rating class. You can see that AAA rated firms are paying about 4.2% on debt. Double Bs are paying almost 10. I've seen triple Cs and junk in the 15s and 20s before. So that's interest payments on their debt. And of course, the higher your interest payments, the lower your interest coverage ratios, and this can be a self-defeating cycle. So this is another way we look at liquidity, we look at capital structure, we measure financial health of the firm. Now, the last thing we want to talk about is leverage. And leverage specifically here refers to financial leverage. And all that financial leverage means when we're talking about it in finance and economics is the use of debt as financing. Right? So leverage, if you think about it in the classical or physical sense, a lever is something that allows you to do more than you would without it, right? So for instance, there's that famous saying, give me a lever and a place to put it and I can move the world. And all that means is that if you use a lever, you get a mechanical advantage and you're able to move more weight than you normally should. Financial leverage is the same way. We use someone else's money, debt, a loan from someone else, put it to work on our investments, and are able to take more investments than we normally could without it. Right? So in my intro class, the example that I give to sort of start people off by thinking about leverage is to imagine the scenario where I'm standing at the front of the classroom and I offer everyone in the room the opportunity to come down to the front of the room, give me any money that they have, and I will double it in the next class. Right? So that's your investment opportunity. Give me your money, I will double it in the next class. If you have $20, I'll give you 40 in the next class. If you have $40, I'll give you 80. If you have 1,000, I'll give you 2,000. Whatever money you have on hand, I'll give you double of it. Right? That's your investment opportunity. Now, leverage means that a Goldman Sachs banker appears in the back of the room and offers free loans to anyone who wants to take them. He says, listen, this is a great opportunity. You never see opportunities like this come around. If you want to take advantage of a loan from Goldman Sachs, you can come back here. I'll loan you as much money as you want. You take it down to the front of the room, you give it to him, he'll double it. So now you have the opportunity to use someone else's money to lever yourself into a position you normally could not be in. You could go borrow $1 million, bring it down to the front of the room. I'll take the $1 million, I'll double it by next class. Right, so leverage allows you to take advantage of an opportunity that you otherwise couldn't be a part of. Now, however, leverage comes with a great deal of risk. The risk here in our silly example is that if all you did was give me the money you had in your wallet, you had $100. You gave me $100. If it turns out I can't fund this investment, that it was all just a hoax, that I took your money and ran, all you were out was the $100. Then that's it. I mean, it sucks. It's a terrible day, but you're not in deep with anyone. Now, if you went back to Goldman Sachs and borrowed $10 million to take advantage of this great deal, you stood to gain a lot, $10 million, right? Double your money. However, when I don't show up and I've run to Mexico with your money, you are now not just out the money you had in your pocket, but also out a $10 million loan to Goldman Sachs, who isn't going to care that the investment didn't work out. They're just going to want their money back. Right? So leverage can allow you as a firm to take advantage of a great deal of projects. And in no way am I saying that leverage is a bad financial choice. Lots and lots of current firms use debt as financing. In fact, it's a cheap source of financing as long as you are safe and careful with it. The risk is that you take too much leverage in order to try and take advantage of opportunities, and then something bad happens, like what's going on right now, and all of a sudden you're in a credit squeeze, revenue drops, you can't cover these very high interest payments, and you end up being in serious financial trouble. During the 2008 financial crisis, there were some firms that failed, that we found out after they failed, had leverage ratios higher than 200, meaning they had 200 times more debt obligations than assets, which is insane. There was no way they could ever cover their debts if they folded. They were just riding purely on loans, and that's an incredible risk. Okay. And we can look at, when we're analyzing our firm, what we should be looking at is, can the firm handle these kinds of leverage ratios? Or can it handle its leverage ratio? In other words, can it handle the kind of debt that it's had over the past 10 years? And the best way to do that is compare the industry level of debt, because that's going to tell us what the average firm can handle. If everyone else in the industry has 60% leverage, meaning 60% debt to value or debt to equity, then we would assume our firm could also handle the same thing. So we're trying to put it in a proper context. We don't want to freak out because they have a lot of debt, especially if they're in an industry where a lot of debt is normal or feasible or cheap, right? And so what we're looking for are particularly the kinds of industries or firms that can handle a lot of debt are ones with heavy fixed asset investment. And that's not necessarily because they can handle it, but because that's the only way to actually raise the money to pay for these assets. So airline industries usually have a lot of debt. We saw that FedEx has a lot of debt. Right. The other kind of industries that can handle a lot of debt are those with fixed payments. So one of the big reasons why you see all the software companies these days transitioning to this subscription model away from, is there even software that you can buy where you get shipped a physical disc and you just buy it and you own it forever, right? They're all going to these subscription models. And the reason is because a subscription model is a steady, regular source of income. And that kind of income is the best for handling a lot of debt. And so if you look at these median debt to value by industry, notice that the internet and software firms in 2003 had almost no debt because they were high growth, they had intangible assets, they were all selling software, and they didn't have regular income. Microsoft was only getting income every time a new version of Windows came out, which was like every 4 years. Now look at the numbers in 2008. They have some of the highest levels of debt because they've all transitioned to this steady, regular subscription income, and that means they can sustain interest payments really, really high relative to other companies and be totally fine. Right? So you can see a number of other industries and how they've handled debt and how their levels of debt and usage have changed. And what we want to be aware of course, is just context. How likely is it that our firm can sustain the debt? Is it in line with all the rest of its industry competitors? And is it a healthy level of debt? So, in closing, what are we trying to do? We are purely analyzing historical performance with the future in mind. We're looking back about 10 years. We're trying to think about how the company's performed, how the company's financial health looks, whether there are any unusual industry trends or anything like that that's coming up that's going to change all of that. We're trying to investigate relative to competition, return on invested capital and revenue growth, because those are going to be the fundamental things that underlie our forecasting, which is what we're going to talk about next. Right? So all of this stuff is about how reliable is past company information going to be when we start to project it into the future, because a discounted cash flow model is based on future cash flows. All right, that's all I got. This is end of the first lecture. I hope you guys are all staying safe. I'm going to get all this posted along with the example problems that I talked about, and I'll hopefully get started on next week and try to have each week's lectures posted at the beginning of the week. If you have any questions, just send me an email, and we'll see you guys next week.